Tax season is here, and we've got everything that you need to know before filing your taxes by April 15th. We'll break down the key changes to the tax code and share expert tips to help you maximize your refund. Let's dive in. Today, we're focusing on some side hustles out there. According to a 2024 Bankrate survey, 36% of U.S. adults earn extra income through a side hustle. Now, the IRS is cracking down on unreported online income, and that means big changes for millions of Americans. Here with me to help, we've got Carla Dennis, KDA Inc. CEO and founder. Great to have you here in studio with us, all the way from California.
Yes, thank you for having me.
Let's dive into this. What are the big changes for side hustles this year?
Yeah, so this year, IRS is requiring the merchant vendors like Yale and different things like that to actually send to side hustle people a 1099-K. That means that if they have any income over $600, they are now going to get a 1099 form. That's going to be different as opposed to last year, you had to make over $20,000 and 200 transactions.
That's a drastic difference for a lot of people.
Drastic change.
And so as we're thinking about some of the expenses, say you have a side hustle, say you're a freelancer as well, what are the expenses that freelancers can deduct to lower their taxable income?
Well, I think one thing that's really important is freelancers need to realize that they're really in business. So they can take any expense that they incur to generate that income. And some of the expenses that they can incur would be like their car expenses, their cell phone expenses, home office expenses, things that they might not even think about, computers, internet, anything a normal business owner would take.
And so what tips do you have for people with a side hustle before they file?
One of the things that they should do before they file is realize all those personal expenses that they're using for business, transition over and start actually taking it as a business deduction. Things like their car, their cell phone, things they're paying out of pocket, their meals, their travel, they should definitely take that now as business. In addition to that, they want to have a separate bank account for their business. Don't commingle funds, because when you commingle funds, IRS can classify those expenses as personal, and you could lose those deductions.
No, that's a great point to make sure that you don't trigger any red flags with the IRS. None of us want to do that. And so as we're thinking about why some of the drastic changes have taken place, I mean, we're talking about going from $20,000 as the threshold to $600,000. Why do you think that is, and how many more people does this potentially impact and bring into this?
Yeah, I think because our government is looking for opportunities to generate revenue. That's the IRS's entire purpose, is to get revenue for the government. So many people, especially during COVID, created side hustles, created these businesses, and they know that there's a lot of unreported income going on. So IRS is looking to crack down, get all the income reported, and making sure they collect the appropriate amount of tax.
Very valuable tips. Carla, thanks so much for taking the time here with us today. Really appreciate it. It's tax week on Wealth, and we've got everything that you need to know ahead of the April 15th tax deadline and what you can still do before you file. Today, we're talking about refunds, because why not? That's the fun part of it. New data from the IRS shows tax refunds are larger this year than last, up an average of 6.3%. The total number of refunds is also up by 1.7%. Joining me now is Andrew Gordon Tax Partner. All right, so we got to know what factors are making some refunds bigger this year, Andrew.
Yeah, Brad, it's great to be here, and that's correct. We're seeing in our practice that more clients are actually getting refunds this year, and that's because of two general factors: the factors that they can control, and then those that they can't, the general tax code changes. Now, first, in terms of parts that they can control, one of the most significant credits or deductions is the child tax credit. And so if you had a kid during the year, you can get an additional $2,000 of credit for your taxes. And up to $1,700 of this is refundable or will be paid directly back to you. Another big change potentially during the year is an investment in an EV or a electric vehicle. If you purchased one during the year, there's another credit that you might be eligible for. But then moving to the changes to the tax code itself, we saw that the standard deduction which many people take instead of itemizing, in fact, increased this year to 14,600. And at the same time, the tax brackets themselves, the amount in each bracket increased with inflation. So if your income stayed exactly the same, you'll still get a larger refund because there's larger tax brackets.
And so with all of that in mind, two of the things that you mentioned are up in the air as to how large those credits will be going forward, even if we do see more of the continuation of the Tax Cuts and Jobs Act 2.0. And specifically, I'm thinking of the child tax credit and then additionally the EV credit, as on day one, President Trump had talked about rolling back some of those incentives. So how will that make the next tax filing season next year even more of a different or a comparable significant change?
Yeah, that's right, Brad. The Tax Cuts and Jobs Act, which was passed several years ago, is actually set to expire this year. And two of the key provisions, the child tax credits and EVs, also set to be reduced if this lapses. Now, President Trump has indicated that he wants it to continue, and in fact, to increase some of the deductions as well. And so there's a lot of hope that it will continue and that these deductions will exist in future years. But for now, it's yet to be seen.
And so how can you adjust your withholdings if you're getting a large refund? Because that essentially means that you're loaning more to the government than you need to on the outset in pre-tax dollars.
You took the words out of my mouth, Brad. If you're getting a large refund, it's not necessarily a good thing. I hear from people all the time, hey, I got a large refund. But the reality is that you've given the government an interest-free loan. And that's because your refund is the difference between your withholding and the tax calculation come filing time. And so if you're paying too much in withholding, you're going to get a large refund. And so a way to counteract that is to reduce your withholding. Now, at the end of the year, you might get less of a refund, but that means more cash in your pocket every month.
Okay, you got some tips for us to help make the most out of your refund. What are they?
So you've got more cash in your hands now. Let's put it to use. And one great way to do so is to pay high interest loans, be it student loans or credit card loans. If you've got some high interest loans, let that money be put to work and let's reduce them. Another way is to invest in retirement. A way to reduce your taxes is through tax deferred retirement accounts. And now that you've got more cash on hand, perhaps increase your investments in retirement. Interest rates are also high right now. So rather than just having the money on hand, put it into a high interest savings account. And finally, consider bolstering or building an emergency fund. You never know when you might need some additional cash.
Andrew, always a pleasure to grab some time with you. Great insights and tips for our viewers out there. Appreciate it.
Thanks, Brad.
Coming up, we'll reveal the most common mistakes taxpayers make when filing and how to avoid them. You won't want to miss this. Mistakes happen, but when it comes to filing taxes, avoiding them can save you time and money. Here's how to do just that. Well, it is tax week on Wealth, and we have everything that you need to know ahead of the April 15th tax deadline and what you can still do before you file. Today, we're talking about mistakes and how to avoid them on your tax returns. Some of the most common tax mistakes include entering information inaccurately, using the wrong filing status, messing up tax credits and deductions, and simple math errors. According to the IRS, 2.7 million returns had math errors during the 2023 tax season. Joining me now, we've got Adam Brewer, AB Tax Law Tax Attorney. So, Adam, we got to know, what are the best ways for taxpayers to avoid these common mistakes?
Yeah, good morning, Brad. The best way to do it is double, triple, quadruple check that return before you hit submit. This isn't a tax year you want to be dealing with the IRS, a lot of back and forth, trying to give them additional information or fix a problem. And so what I'm telling my clients is make sure you check those portals on your brokerage accounts, your employer email account. Make sure you check your traditional mail. We have all these tax documents that are coming in different ways now. It's not just all in the mailbox. So you really want to make sure that you're picking up all of those documents, reporting all of that income, because you don't want to be, like I said, going back and forth with the IRS trying to get a tax return process this year.
What types of penalties can you face for making a mistake on your tax return?
Yeah, so the most basic one, I think we'd see like a 25% accuracy related penalty. But keep in mind, these aren't mistakes that are often picked up day one. So you're going to pay an accuracy related penalty. You're going to pay a late payment penalty. That's 0.5% per month, up to 25%. And then they're going to charge you interest on top of that. So if this is a mistake that they realize you made a year from now or 2 years from now, it's not unexpected to see that the amount of tax equal the amount of penalties and interest.
So if you already filed with a mistake, what can you do?
Yeah, so if you already filed, if you were proactive, you said, hey, I'm going to do the right thing, get this return in early because I'm worried about staffing cuts or because of the government shutdown potential or because you want a refund, then you have to file an amended return. And so fortunately, you can now do that electronically. And that's for taxpayers, whether they owe additional money or whether they realize, hey, I overpaid. The IRS owes me money. Either camp can file an amended return electronically.
So how does the process change if you paid too much versus if you paid too little?
Yeah, so the process is more or less the same. It's still going to be an amended return. I'd say it's the urgency side. So if you owe the IRS money, you want to get to that before they realize, hey, this taxpayer didn't report everything. Again, that minimizes the risk of penalty assessment. And that will minimize how much interest you owe them. And so those taxpayers, they want to get that amended return in as quickly as they can. Likewise, if you overpaid, better the money in your pocket than the IRS is. So you also want to get that amended return submitted. I guess there's just not that level of urgency where you realize, hey, every day I procrastinate on this, I'm going to be paying additional penalties and interest.
So what if you owe more money than you can afford to pay when you're filing?
Yeah, so it's really common, especially with all the gig economy income. A lot of these taxpayers now, they're going to have income from sources not subject to withholding. So if you're driving an Uber, driving Lyft, DoorDash, put your house on Airbnb, you're going to end up owing money in a lot of those cases. And so the one thing I tell all my clients is if you owe, don't let that fear of owing the IRS stop you from submitting the return. Look, this isn't like a soft, cuddly IRS. They're not eager to help you out necessarily, but they do have programs. So you can get on an installment agreement. You can tell them, hey, I need 180 days to pay this balance. And they'll give you that time. They're going to charge you penalties and interest. If it's an amount that's insurmountable, there is an offer and compromise program. There is hardship status. But it really depends on how much you owe and how much time you think it's going to take you to pay it.
Adam, thanks so much for taking the time. Really appreciate it. Some valuable tips
All right,
for those
thank you,
trying to
Brad.
avoid
Have a
those
great day.
mistakes. Thanks, you too. Next, we'll explore strategies to help retirees minimize their tax burden. Yahoo Finance's Bob Powell, host of Decoding Retirement, joins us with expert advice on reducing taxes in retirement. The number of Americans expressing confidence around their retirement prospects dropped 7% from last year, according to a new Fidelity study. We want to help address that with those tips for people who are close to or already in retirement. Joining me now on set, we've got the host of Yahoo Finance's Decoding Retirement podcast, Bob Powell. Bob, let's talk about financial planning for your golden years, particularly around taxes, since we've got that April 15th deadline coming up. We're a month and change out from it right now.
Yeah, so a couple things that are worth noting. RMDs are one of the biggest causes of taxes in retirement. And there are some things that you need to know about RMDs, some background. First, distributions from IRAs and 401ks are required, and those required distributions are different based on your birth year. So it could be 70 and a half, could be 72, 73, 75, a little confusing. But the thing about RMDs is that they're taxable income, and when you take it, it could bump you into a higher tax rate. You could go from 12 to 22, or 22 to 24, or 24 to 32%. So there are some steps you can take to avoid these adverse effects of RMDs. So one is to start thinking about doing full or partial Roth conversion so that you reduce the RMDs when it comes time for you to take these distributions. distribution. The other is to start drawing down before you reach RMD age, and that could reduce the RMDs when you get to RMD age. And then the last thing you can do is if you're 70 and a half and older, you can take something called qualified charitable distributions, or QCDs, which are not taxable, and those are one way that you can at least avoid the adverse effects of RMDs.
Certainly. You know, another consideration here too is your premium management, especially if you have Medicare Part B. What do people need to know about that?
All right, so if you're enrolled in Medicare Part B, you're going to pay a monthly charge. It's called it's roughly on the order of $185 per month, and about 92% of Medicare Part B beneficiaries pay that amount. But if you have what's called a modified adjusted gross income that is above a certain threshold, you may pay anywhere from $259 per month to upwards of $628.80 per month, depending on your modified adjusted gross income, or MAGI, as they like to say. So there are some things that you can do to avoid paying this extra surcharge. One is, if you're doing Roth conversions, you want to be mindful of the effect not only on your taxable income rate, but also on your modified adjusted gross income, because if you push yourself into a higher MAGI, you're going to pay the surcharge. If you're pre-RMD and 63 and older, you also want to be mindful of drawing down your IRAs, because one of the things that taxable income will do will also make your MAGI higher as well. And the last thing you want to be mindful of is this notion of, if you have a severance package or a bonus, or you're selling assets, that income could push you into a higher MAGI as well, and then increase your Medicare Part B premium. One last note about this, Brad, is there's a 2-year look back on Medicare Part B premiums. So in 2025, your Medicare Part B premium is based on your 2023 tax return, and your 2026 premiums will be based on 2 years look back from there, so your 2024.
Oh, wow. Okay, so let's talk about the entire reason why you saved up this nest egg, because you want to draw upon it. How can you best prioritize how to kind of disperse those funds and make sure that the money stretches over time?
Yeah, so one thing I will start by saying is, if you have access to a health savings account and you haven't yet retired, consider contributing it to that, because it's triple tax-free. The money goes in tax-free, it grows tax-free, and withdrawals are tax-free if used for qualified medical expenses. When you're in retirement, you want to think about drawdown strategies. So what's the most tax-efficient way to do that? Take money from your taxable accounts first, then from your tax-deferred accounts, your traditional IRA or traditional 401k, and then from your Roth accounts. And the logic is that this allows the money in your tax-deferred account and your Roth accounts to continue to grow. You also want to consider tax-efficient investments. So if you're in a mutual fund, maybe consider using an ETF. And then if you need tax-free income, municipal bonds are tax-efficient as well. And then the last thing I'd mention is, think about account location, where you put the assets, which assets go into which account. So tax-efficient investments go into your taxable account, tax-inefficient investments go into your tax-deferred accounts, and then your high-growth potential investments go into your Roth.
It's a great breakdown. Bob, thanks so much. Tax season is in full swing, and while many deductions had to be made by the end of 2024, guess what? There's still some time to reduce how much you owe ahead of the April 15th filing deadline. Joining me now, we've got Lisa Green-Lewis, TurboTax tax expert. Good to have you here with us. What are some of the last-minute moves that filers can make right now to lower their tax bill?
Yes, first, thank you for having me. So there are not a lot of moves that you can make to impact your 2024 taxes now, but there are a few. So you can make an IRA contribution up to $7,000. And if you're 50 and over, up to $8,000. And you can do that up until the tax deadline and make an impact on your 2024 taxes. You just need to make sure you tell your plan provider that that is a 2024 contribution. And then at HSAs, you can contribute $4,150 to a self-only high deductible health plan. And you can do that up until the tax deadline. And then if you have a family high deductible health plan, you can contribute up to $8,300, and you may be able to deduct that contribution.
So there are still tax credits that filers might be eligible for. Can you walk us through some of the tax credits potentially for people with kids?
Yes, so there are a lot of benefits when you have kids. So the child tax credit, that's up to $2,000, and $1,700 of that is refundable, meaning you don't need to owe taxes in order to get that $1,700. Then the child independent care credit. So if you took your kids to daycare while you work, you'll be able to take a credit of up to $1,050 for one child, up to $2,100 for two or more kids. And that's even if you take them to like a sports camp.
And so what about tax credits for education? And I'd like to think that some of my sports camps growing up were education enough. But of course, for real education and for progressing towards degrees, what about those tax credits?
Yes, so you can either take the American Opportunity Tax Credit for your child or yourself. That is for the first 4 years of college, and that's up to $2,500. You can also take the Lifetime Learning Credit, and that's even if you just take one college course, and that's up to $2,000.
And so all of these things considered, I mean, these are significant. But there are also tax credits related to energy, which is perhaps a little bit more near and dear to a lot of people's weekly purchases or even monthly purchases as well. How significant is that?
Yes, so under the Inflation Reduction Act, there were expansions for energy efficient credits. So if you replace energy efficient doors or windows in your home, you can get a credit of up to $1,200. And with the Inflation Reduction Act, they also did away with that lifetime credit of up to $500. So now you're able to get more. Also, there is a $2,000 credit for solar heaters. And then if you put solar panels in, you can get a credit of up to 30% of the cost of what you spent on your solar panels.
All right, now there are also two other credits that many people miss out on. What are they?
Yeah, so the IRS reports every year that there are two credits that 1 out of 5 people miss out on, and that's the Earned Income Tax Credit. And it is a substantial credit. A family with 3 kids can get a credit of up to $7,830. And then the Retirement Savers Credit, that's a little known credit. You get it just for investing in your retirement. And that's up to $1,000 if you're single and $2,000 married filing jointly.
Wow. Okay, finally, some things that people can do now to reduce their tax bill next year. What are they?
Yeah, so if you weren't happy with your outcome after you did your taxes, you can adjust your withholdings. That's one thing you can do. You can pay estimated taxes, but another really great way is just maximizing your retirement. So you can contribute up to $23,500, and if you're 50 and over, $30,500. And then new under the Secure Act, if you're 60 to 63, you can contribute more, $34,750. And you're building your nest egg while growing your retirement, and you may be able to get that savers credit as well.
All right, all steps that I'm trying to do. Lisa, appreciate the time. Thank you.
Thank you for having me.
Thank you for watching. Stay tuned to Yahoo Finance for the latest financial news and updates.